President Trump's push to get the Federal Reserve to lower interest rates could backfire, pushing long-term rates higher. This according to Jim Bianco of Bianco Research.
You cut rates or threaten to cut rates, and you'll produce higher long-term rates.
Yeah, and we already saw a preview of this when the Federal Reserve cut interest rates in September of last year, with yields on longer-term U.S. government bonds surging over 100 basis points, over 1%, even with the Federal Reserve on the rate-cutting path. And this is a serious consideration as the president continues his fight against Fed Chair Powell, pushing the Fed into cutting rates.
He's not a smart guy.
You stupid. Huh?
But the president, in his own way, also recently alluded as to why this matters so much beyond interest rate policy.
But we're going out because Biden gave us a lot of short-term debt.
Yeah, as we'll see today, this persistent pressure on the Federal Reserve reflects a deeper tension in the financial system, one that becomes especially visible through the lens of activist Treasury issuance, how the United States funds its debts. So what I want to do today is go over why Bianco says interest rates could pop if Trump gets what he wants, discuss some of the deeper problems in the financial plumbing of U.S. debt, and then go over some implications. Speaking of U.S. debt, we are eagerly awaiting to see how the passage of this big, beautiful bill turns out, and we'll obviously have updates out on that bill on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, let's get into the Fed rate. Onto the Fed lowering interest rates. As we are all well aware, the president has been on the warpath, especially over the past few weeks.
And this guy could do it so easily. We don't have inflation. Well, we might have inflation.
And while Chair Powell has remained strident in his defense of the Fed's path, we're seeing more and more Fed officials break from the once unified FOMC. Fed Governor Waller saying the Fed could cut rates as soon as July, a move that was backed up by Michelle Bowman, who also said she'd be in support of a July rate cut. Yet, Bianco questions the extent to which these members actually think it's time for a rate cut, or if they're vying for a bump up the ladder.
We're seeing more and more that it seems like it's being political as far as whether or not the Fed should cut rates. You've got the parlor game getting played. Who's going to replace Powell? They're all coming out, whether it's Kevin Hassett or Chris Waller or Michelle Bowman, who are on supposedly the short list of who President Trump is considering to replace Powell, all trying to one-up each other by saying we need to cut faster and sooner. And it sounds more like it's a political thing to kind of get into the graces of President Trump than it is to make economic arguments. If it is political, then you could see a repeat of last year. You cut rates or threaten to cut rates, and you'll produce higher long-term rates.
Yeah, as we saw with the fall of Liz Truss, the fiscal authorities can do what they want. The central bank can do what it wants. But the market, as we saw post-September of last year, will also do what it wants. The Federal Reserve first introduced 2024 rate cuts in September, cutting interest rates by 50 basis points, cut again by 0.25 in November, and another 0.25 in December. A total of 100 basis points, 1%, worth of interest rate cuts. Since then, we've seen the yields on the 10-year Treasury spike by almost 130 basis points, peaking in January, and are still about 0.7% higher, 70 basis points, as of the recording of this video. So, the Federal Reserve, while they can lower interest rates, they do not set long-term interest rates. Those are set by investors in the U.S. Treasury market. If investors think that the Federal Reserve is acting politically, that they've acted prematurely, are acting in a manner that's going to set off inflation, then they're going to demand a higher yield when they lend money to the United States. Which makes complete sense. If I lend the United States $100 at, say, a 3% interest rate, I know I'm going to receive $103 back at the end of the term. But if inflation is going to be 4%, then I'm actually losing money lending the U.S. money. So I'm going to be demanding a higher yield. And that's what Bianco is saying, is that if the Federal Reserve prematurely cuts, if the market gets the idea that the Federal Reserve's policy is going to result in inflation, then they're going to demand a higher yield when they lend the United States money for 5, 10, 20, 30 years. As such, even if President Trump gets his rate cuts that he's been pushing for at least the past few weeks, that could still mean higher borrowing costs for you and I. But the president alluded to something interesting when he was speaking to reporters last week, noting that his government is almost forced to rely on the Federal Reserve due to actions taken by previous governments, mainly the Biden administration.
But we're going out because Biden gave us a lot of a short-term debt. And given a short-term debt, he did us no favor.
And I know what you're thinking, a politician blaming the previous administration, what else is new? But in this case, Trump actually has a really good point. During the Biden administration, then Treasury Secretary Yellen was criticized for what's called activist Treasury issuance. Yellen was borrowing relatively more short-term debt to fund the U.S. massive fiscal deficits, $2 trillion in 2024. So rather than borrowing long-term debt, say 10, 20, 30-year debt, which would have pushed up longer-term rates, those rates for those 30-year mortgages higher, Yellen had been relying on short-term debt issuance. This enabled Yellen to keep longer-term rates artificially low, which, according to Nouriel Roubini, enabled a type of stealth quantitative easing, stimulating the economy by artificially lowering interest rates, essentially sidestepping the Federal Reserve. In this move by Yellen, this move by the Biden administration, had actually been criticized by the current Treasury Secretary Scott Bessent, noting that with the administration borrowing more than $1 trillion in short-term debt, Yellen was distorting Treasury markets. And it's not only this distortion of the Treasury markets that's the problem. By relying more heavily on the short end of the curve, by relying more heavily on short-term debt, it creates a real liability for the United States, as it has to continually roll over, has to continually refinance all of that short-term debt. And we can see the results of this occurring in real time. The United States this year alone has $9 trillion in debt maturing. 21% of that debt is from short-term bills, meaning debt that was taken out over the past few years. And that's quite high. Back in 2021, the US only had 15% of its maturing debt from short-term bills. And that's a big reason why President Trump is focused so much on getting the Federal Reserve to cut rates. He has an awful lot of debt maturing this year, almost 1/4 of which is debt left over from the Biden administration, who took out short-term funding in order to provide artificial stimulus. But let's be clear, Trump wants these lower rates not so that he can fix the Treasury manipulation that was started under former Treasury Secretary Janet Yellen. No, he wants these lower rates so he can do the exact same thing that Yellen did.
Given a short-term debt, he did us no favor. So I think what we'll do is we'll probably just extend the short-term debt and then go up, because I don't want to tie it up for 10 or 15 years at a high rate.
So on the one hand, yes, Trump is 100% correct. Lower interest rates would help with that maturing debt, the total tonnage of which is only maturing this year due to the Biden-Yellen regime relying so much on short-term debt to keep interest rates down, something about which the current Treasury Secretary was quite vocal during 2024, saying Yellen used her position to juice the U.S. economy. But on the other hand, Trump is looking to do the exact same thing. Borrow more and more on the short end of the curve in order to keep government borrowing costs down, which will help him with his big, beautiful bill, etc. And obviously, as we've seen, this isn't fixing any problems. Rather, what it's doing is creating more and more problems for the next guy. What Biden and Yellen did created more problems for the current president, and if he gets those rate cuts, enabling him to borrow more money on the short end of the curve, that will create even more problems for the next guy behind him. With that said, we will obviously continue to track how all of this plays out on this channel if Trump gets those rate cuts from the Federal Reserve on this channel. Make sure you click like and subscribe if you want to get those updates. But for now, thanks so much for watching.